It looks like the Chancellor Rishi Sunak could have found a way to generate an awful lot of tax revenue to pay back some of the cost of the COVID-19 pandemic. If he takes on board new recommendations out today, he could double the take from capital gains tax. So coming up in this video, why we might all be paying much higher CGT in the future. Hi everyone, I'm Martin Bamford, a chartered financial planner and informed choice, and in this video I'm taking a look at new recommendations from the Office for Tax Simplification that could lead to a doubling of capital gains tax. Now, we know that a review of capital gains tax has been on the cards for quite some time now. The Office for Tax Simplification has been looking at this tax, looking at how effective or ineffective it is as things stand, and asking some questions about whether the tax could be reformed. And in broad terms, their recommendation is to remove capital gains tax exemptions and to double the rate of tax to bring capital gains tax into line with the rates of income tax. They think that because of this difference between tax rates for capital gains tax and tax rates for income tax, some people can distort their behaviour to effectively pay less tax by realising capital gains than earning income, and that's why they're making these recommendations. So as things stand, capital gains tax in the UK is charged at two rates. If you're a basic rate taxpayer, it's charged at 10%, and if you're a higher rate taxpayer, it's charged at 20%. However, UK adults receive an annual capital gains tax allowance or exemption. This tax year, 2020-21, that exemption is £12,300. So on the first £12,300 worth of capital gain you make in a tax year, there is no capital gains tax to pay. But on the balance above that exemption level, you pay at 10% or 20%, half the rate of income tax, because for a basic rate taxpayer, income tax is charged at 20%, not 10% for CGT, and for a high rate taxpayer, it's charged at 40%, not the 20% charged for CGT. If the Treasury were to adopt these recommendations from the Office for Tax Simplification, it could increase the tax take from capital gains tax by £14 billion a year. That's nowhere near enough to pay back the cost of the COVID-19 pandemic and the additional government spending that's happened as a result of that, but it does make a healthy contribution towards the deficit, and it's something no doubt the Treasury and Chancellor Rishi Sunak will be considering. It is fair to say there is a disparity between income tax and capital gains tax, leaving aside the different rates that are charged on the two and the fact that capital gains tax is charged at approximately half of income tax rates. More than 31 million people in the UK pay income tax each year. By way of contrast, only around 265,000 people pay capital gains tax. So a huge difference between the number of income taxpayers on one hand, the number of capital gains taxpayers on the other. And that £12,300 annual capital gains tax allowance or exemption is really important too, because approximately 50,000 people each year pay less or pay no capital gains tax because their capital gains come under that threshold. And there are ways to structure your realised capital gains each year to ensure you remain under the annual threshold. For example, if you transfer capital assets to a spouse or civil partner in the UK, there's no capital gains tax to pay on that transaction. And then when your spouse or civil partner sells the assets and realises a capital gain, they also get use of a £12,300 allowance. So some clever tax planning can take place, keeping people, and in fact about 50,000 people a year, under that annual allowance threshold. Some other recommendations then made by the Office for Tax Simplification when it comes to their review of capital gains tax. One is to completely remove this current rule which scraps any capital gains tax to pay on inherited assets. So when somebody dies, their assets, the value of their estate, is subject to inheritance tax and not the capital gain on the value of their estate during their lifetime. So capital gains tax is effectively wiped out when you die. The Office for Tax Simplification wants to see that scrapping of capital gains tax on inherited estates removed, and that could also raise more tax revenue. They have also suggested in their review that they would like to remove the current capital gains tax exemption on ownership of unlisted business assets. As long as you hold unlisted business shares for at least 3 years, there's no capital gains tax to pay. And again, that can lead to some quite clever tax planning investment products. and the Office for Tax Simplification would like to see that exemption removed as well. Now, the one ray of light for taxpayers when it comes to these recommendations is that we have a Conservative government in place, and should the Conservative government accept these recommendations, they are likely to be alienating their voter base, who tend to be wealthier individuals, because taxpayers who sell second homes or sell investments, should these rules change and should these exemptions be removed from capital gains tax, should the rates of tax go up, these are the taxpayers that are going to be paying significantly more each year in capital gains tax, and politically that's unlikely to be a very popular move with the government. However, it was Rishi Sunak, our Chancellor of the Exchequer, who commissioned this report from the Office for Tax Simplification back in the summer, back in July. So this is something he wanted to look at, something he wants to explore, to look at these inequalities between capital gains tax and income tax. So for that reason, we shouldn't feel too confident that he's going to read the report and just completely ignore all the recommendations. However, it is unlikely that this is top priority right now. And in fact, responding to the publication of the report, a spokesperson for the Treasury said the government's priority right now is supporting jobs and the economy. We thank the OTS for their independent report, which will be considered in due course. And I have previously said that raising taxes, whilst inevitable and whilst it's something that has to come to pay back the cost of the COVID-19 response, that is not something that's on the cards right now. Right now, it is about spending money. It's about supporting jobs, saving businesses, supporting the economy. The tax rises, they have to come later, and the most likely outcome from those tax rises is a combination of measures. It won't be an attack on one single type of tax, but all sorts of taxes will be reviewed, in my belief, and increased over time to pay back for all of this extra government spending that's taking place. What do you think of these recommendations from the Office for Tax Simplification? What do you think of capital gains tax as things stand, and this disparity between how capital gains tax is paid and how income tax is paid? Let me know in the comments down below. I'd love to hear your opinions on this one. Until next time, I'm Martin Bamford from Informed Choice, and remember, when it comes to your money, the more you know, the faster it can grow.